News that's come in from the Reserve Bank. There's been absolutely no reduction in your EMIs. The central bank has kept the repo rate and the reverse repo rate unchanged today. So the repo rate stays unchanged at 8%, but the central bank has cut the cash reserve ratio by about 0.25%, brought it down to 4.25%, and that move is expected to inject 17,000 crore rupees into the banking system. The RBI has also lowered the growth forecast to 5.8%, down from 6.5%. This projection is for 2012-2013. Inflation projection, unfortunately, is up. It's up to 7.5% by March end next year.
The policy stance anticipates the projected inflation trajectory, which indicates a rise in inflation over the next few months before easing in the last quarter of this fiscal year. While there are risks to this trajectory, the baseline scenario suggests a reasonable likelihood of further policy easing in the fourth quarter of this fiscal year.
CRR cut is also some indication. It is not as if that the inflationary situation has not eased. I think it has come down from the very high levels that we saw in 2010. But at the same time, I believe that it is an assessment of the Reserve Bank that some little improvement in liquidity would do good. Therefore, they are balancing two considerations.
And we just want to take you through the markets. Well, they didn't react very well to the RBI credit policy announcements that came through. The Sensex, in fact, slipping close to 200 points earlier, down 185 points after those policy announcements. Currently 18,450. Nifty also, just bringing that up for you, down 65 points, slipping below 5,600 in trade. Big losers of that rate-sensitive, of that cut were those rate-sensitive stocks such as the banks and auto stocks. Just for a bit more on this, let's take you across to our banking editor, Lata Venkatesh.
The Reserve Bank did not give an expected repo cut, as it is called. Repo is the rate at which banks borrow from RBI. At the moment, it stands at 8%. If RBI were to lend money at, say, 7.5%, then banks can usually pass on that interest rate. It's a very powerful signal. But the Reserve Bank has decided not to do that. All they did is they have allowed banks to lend a little more by cutting what is called the CRR. The CRR is the percentage of their deposits which banks have to keep idle in the form of cash with the government. It was at 4.5% of their total deposits. Now they need to keep only 4.25% of their total deposits idle. So they get that little bit more money to lend. That brings 17,500 crores into the system. So they get the ability to lend a little more and perhaps make a little more money. That's all there is to say for the credit policy. Why has the Reserve Bank remained so much reined in and not allowed banks to cut rates? That's quite clearly because they are not very sure inflation will come down. Inflation has remained very sticky. First things first, the Reserve Bank always relates inflation to interest rates. If the cost of money is kept high, then people save more and spend less, and that keeps inflation controlled.